Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby, and today I'm joined by someone that is known and loved by the advisor community. It's Ben Carlson of Ritholtz Wealth Management. He is, of course, the author of multiple investing books, creator of the fantastic blog, A Wealth of Common Sense, and co-host of one of my favorite podcasts, The Animal Spirits Show. He has a reputation for deep thinking around market history, investor psychology, and portfolio construction. And we're here today to talk about his newest book, Risk and Reward, which I've just completed and really enjoyed. Ben, welcome to the show.
Thanks, man. Glad to be here.
We are rocking our respective mini football helmets this morning. Great to be here with you. I wanted to start out with something. One of the most consistent pieces of advice that I give to folks who are learning about markets, new to markets, is to be a market historian. And I think you do this just about better than just about anyone. But I think there's a paradox here, which is that sometimes the lessons of history can seem kind of dusty and they can seem remote, or not have all sort of the emotional punch of real-time involvement in markets. So as a market historian, how do we sort of make the lessons of history come alive for investors in a way that'll shape their behavior today?
Yeah, it's interesting. The thing I get out of history most is the numbers are great and learning about the ups and downs, but it's like the stories of the people and how I especially love the boom times and the busts, because you see how crazy people go and you hear the anecdotes and the stories and you go, oh my gosh, what were people thinking? How could that possibly have happened? And how can the pendulum swing so far in one direction? And yeah, you get these stories of individuals, and especially the best ones for me are not just the regular people, but like the really, really smart people who lose their mind, right? Like Isaac Newton is probably one of the smartest people ever born, right? He created calculus essentially. He got caught up in FOMO during the South Sea bubble, right? Because he saw other people getting rich. And I love stories like that just show how human beings, we just can't help ourselves sometimes. And that's, I think, the good lessons of history is just like how the emotions can just swarm you.
Is the South Sea bubble your favorite? Like when you look back over these historical disasters, is that your favorite? Is there an event from history that you think future generations won't even believe actually happened because it seems so strange at this point?
Oh, that's a good one. Yeah, like the Tulip Mania, South Sea bubble is a good one. The Great Depression to me is kind of, that's the one that I keep coming back to. The fact that I don't know how the country even survived that, considering it was, about 100 years ago. So it's the South Sea bubble is a few hundred years ago. A lot of that other stuff is way, way back when. The Great Depression was, 100 years ago or so. And we had 20% unemployment for the better part of a decade, maybe a decade and a half. Basically, it didn't really end until World War II, and there was no financial backstop. There was no Social Security payments. There was no unemployment insurance. All that stuff came about because of the Great Depression. So right. It's almost like we had to almost go through a situation like that to learn our lesson. The Fed didn't really step in because they were still so new, and they kind of made things worse. And that's you think about how quickly government officials step in now, when COVID hit. If that would have happened 100 years ago, we would have had a depression probably.
Yeah.
Right? What happened if we just turned the economy off and let it sit on ice for 2 months like we did? If that would have happened back then, we probably would have had a depression. So I think that one to me is just the craziest one of just how long it lasted and how painful it was to people at the time.
Well, that's, I want to keep pulling on this historical thread a little bit, because that's, I think, one of the places where the lessons of history can lead us astray almost, right? Because I think, going into COVID, you look at the Great Depression, we 75, 80% drawdowns, years and years and years to come back. I think given the fiscal and economic tools we have at our disposal now, it's just maybe I'm being silly here, but I'm just like, that's just not going to happen. Like they won't let it happen.
Yes. No.
Yeah. Do you agree?
Yes, I do agree that. I think that like there's the old saying that like those who don't remember history are doomed to repeat it. But I think that there's another corollary there of like people who study history too closely, like are doomed to like take the wrong lessons from it. And I don't think that I mean, the stock market is just so much more important to us today. Like the stock market crashed almost 90%. Like there's no way we could allow that to happen today. It would be anarchy, right? It wouldn't. So I do think that there's lessons from history that you have to kind of put a little context around. And I think one of my biggest things about studying history is just like how surprising the outcomes tend to be, right? That you can't really predict where the risks are going to come from and how it's going to end. And you couldn't have said like, well, the Great Depression is the whole economic malaise there is going to end because we're going to go into another war. Like no one would have said that's going to be the outcome that gets us out of this, right?
Right.
Or that the outcome of the war would leave the United States like standing while the rest of the world was in like a cloud of dust essentially. And so I think that's, no one could, and it's funny, after the Great Depression, the whole thing was there's these Great Depression babies where everyone for a generation was frugal. They didn't want to take risk. No one wanted to invest in anything, right? You looked at the stock market chart back then, I have it in my book, and it's like, who would think that this is stock so long? No way. And of course, the outcome of COVID was, people are turning into degenerate gamblers and they're speculating and they're spending like crazy and they're doing, and no one wants to like pull back at all. So it's complete opposite. So that's another thing about history is that like sometimes the reaction to the event is more important than the event itself. Like what does it do to shape people for generations? And for the 2020s, it could be that like we've created this whole thing where everything is financialized and the markets are just so much more important. And then it's like, okay, what risks did we create there? And we don't really know. And you talked about like taking away the Great Depression, like we lopped off that left tail, right?
Mm-hmm.
For all intents and purposes, I agree with you. But what risks did we set ourselves up for because of that? I don't know the answer to it.
Right. No, absolutely. Now, it's wild to think about the lessons we learned from COVID. Everything's been financialized. The Great Depression gave us my Nana, who won't throw away a piece of bread and yelled at me once for not picking up a penny I saw on the street. And COVID gave... And, COVID gave us Cauchy and,
Yeah, no, I have my dad, his parents were a product of the Great Depression. We always make fun of my uncle, puts tin foil in the dishwasher and uses it again.
Yeah.
Because they had that passed down from their parents. Like, yeah, it's funny to think what those ramifications are going to be.
No, on a walk with my Nana, saw a penny. I was like, oh, a penny. She goes, pick it up. I'm like, nah, who cares? Smacked me. Thanks, Nana. Love you. I want to keep pulling on this history thread. The chapter title that made me laugh the most was Now Show Japan. And I think anyone who is sort of chronically online in financial spaces like the two of us is familiar with this sort of Now Show Japan mindset. That's another one, I think, perhaps where an awareness of worst case scenarios is actually harmful to investors. Can you talk about that Now Show Japan mindset and how you think it steers people awry?
It's funny. I told my publisher, I'm like, what if there's a Japanese version of the book, can we call it Now Show Japan, please? Like, I just because that saying is, as someone who talks about like the benefits of long-term investing, it's constantly being thrown in my face. Like, hey, what do you, and that was one of the reasons that I wanted to write the book, because I wanted to look at all the exceptions. But you're right. If you spend all of your time trying to plan against the exceptions and the outlier events, then what are you ever going to invest in the first place? Well, this bad thing could happen, so I can't invest in this, and that bad thing could happen. And I think that's the thing. If you look at just those outlier events and that's your takeaway, that like, okay, fine, now I can't be a long-term investor. That's not the right mindset for it. I think you have to understand that these bad things can happen, lost decades and countries that do really poorly and all these things. But the point is that like there are ways to protect against it. It's not like it's the end of the world just because that has happened in certain places or that has happened to certain assets. Every investment strategy, every investment asset has gone through periods where they just don't do anything for a long time, right? Or they have a crisis situation. And I don't think looking at those exceptions is a helpful way to invest. You can't spend 95% of your time worrying about stuff that happened 1% of the time. It's so I think the stat I give in the book is that over the last 100 years, the United States has been in a recession 14% of the time or something. I think about how much time people spend preparing for those times, right?
Yeah.
We haven't had, the COVID thing was 2 months. It was a flash in the pan. It wasn't a real recession because we threw so much money at it, right? That one didn't, it wasn't like an economic cycle.
Yeah.
It was kind of man-made. So we haven't had a real recession in like 17 years. Think about how many recession predictions there have been in that time.
Yeah.
And how much time people have spent worrying about it and preparing for it and forecasting it and all these things. So I think if that's your MO, that you're constantly in the fetal position, like you're never going to like move the ball forward at all. What's the point?
Yeah. I was thinking about this morning on the way on my drive into work. On the one hand, I'm of course so grateful for my career, and I feel like I found this great niche and love everything that I've learned from my work in markets. And then on the other hand, I can't help but think I would be a better investor if I were completely unaware of things like Japan. Like, I mean, as someone with sort of a natural negativity bias and sort of a predisposition to worry, because there's no such thing as a well-adjusted psychologist. Nobody goes into this because nobody goes into this line of work because they're carefree. I know that I have played it safer than I should have because of my awareness of some of these things that's like made me worry. And I think lopping off the tails, like you talked about before, is not a bad way to think about markets, to play for that 85%.
No, I agree. And part of it to me is like, I've heard about all these bad things that happen too. And my solution, I don't think there's really a free lunch in finance, but diversification is probably as close as you can get. I know a lot of people who just have naively put, most of their money into the US stock market or large cap growth stocks or tech stocks in the past 10 or 15 years. And they haven't worried at all about like the risks or the downside of it, and they've made more money than a diversified investor, right?
Yeah.
And I'm a diversified investor, right? They probably have better performance. And sometimes you go like, why can't I just be that naive sometimes and not have to put too much thought into it? But then I also think of what happens when the tide does turn, because everything is cyclical. You don't know how long the cycles are going to last, but everything is cyclical. So then you wonder, what's the strategy when the cycle turns? Then what do you do? And I think a lot of people don't have an off ramp or have a fallback plan of what happens when this stops working. Then what do I, it's like Forrest Gump when he's running across the country, all those people are following him. And then one day he just kind of stops. So I'm going home and people are like, what do we do now?
Yeah.
And I think you don't want to get to the point where you have to ask, like, what do I do now? What is the next step? And you don't know it. That's the place that I never want to be in. Yeah.
Perfect analogy. You talk in the book, one of the chapters is called Doing Nothing is Hard Work. And I think, I want to kind of tackle this from two angles. One of the hardest things to do in markets, I think, is to convince people that there is dramatic upside to limited action. I think that's hard for individual investors to buy into because of action bias. And I think from a marketing perspective, it's hard for advisors to sort of market this level of passivity. So both from the advisor perspective and from the investor perspective, how do we get people to realize the value of nothing?
It's really hard to do because you're right. The strategies that are more complex are easier to sell.
Yeah.
And in action, in most areas of life, action is a good thing. Trying harder helps, right? You study harder, your grades should improve. You go to the gym a lot, your health should improve. These types of things, like there's a natural correlation there. And most people think that that's true in the markets too. And there's a lot of smart people from outside fields that assume that if you bring intelligence into the markets too, it's easier to beat them, right? There's a lot of doctors and engineers and lawyers that say, hey, listen, I'm a smart person. I went to school for a long time. I'm going to bring that intelligence to the market and it'll automatically translate. And that's a hard lesson to learn, that there are no like degrees of difficulty, right? There aren't like extra points awarded because you're smart or because you try hard. And that illusion of control, like if I just do something, anything, it will help. And there's this like old Roman army rule that like action removes fear, right? If I do something and like in war, that's a good, like you do something and you can move forward. And so I think people have this mindset of if I just like press the button and I do something, it's like a pain release valve. Like, oh, I feel so much better. And the thing that I tell people is that, like, no, you have to do those things in advance. You don't want to do it in the time, like, because I know myself personally, most of the time, my like discretionary thoughts about the market versus the rules that I've set in place, like most of the time, if I would have followed my gut instinct, I would have been wrong.
Yeah.
Right. My rule that I set up in advance says, if X happens, you should do Y. And then I follow the rule and I go, geez, but it doesn't feel very good, right? Most of the time that rule is right because I put it in place in advance. And I think that's the point, is that you have to do nothing. You have to have those rules in place, like guidelines, some sort of like bumpers, essentially, right? And so I think that's the thing that people have to realize, is that doing nothing isn't just like sitting on your hands and hoping for the best. It's like creating a plan that you can follow and having some if-then rules. And sometimes, most of the time, hopefully that if-then framework is like, if this happens, don't do anything, right? Your plan says to just stay the course. And that's the thing you have to realize, is that you have to do the heavy lifting up front.
Amen to all of that. I think it's so fascinating. Like, something like a core and explore or core and satellite approach that some advisors use, while I think that's of sort of marginal value add from an actual dollars and cents standpoint, I think that sometimes it has this veneer of complexity that might get, the average investor to sort of take their medicine and do the 95% of the thing that they should do. I almost wonder if sometimes we don't need to add in a little razzle dazzle, 5% razzle dazzle, just to get people to take the medicine of the 95% they should be doing.
So I completely agree with that. And that's actually something that we do for our clients.
Yeah.
So we have, and it's not everyone, because some clients say, no, I can be a robot. I'm the Spock. I've sat through stuff before. I don't need it. But some clients say, listen, to let my 90% go fine, sit over there, it's long, buy and hold and rebalance and all this stuff, I need the other 10% like behavioral release valve that shows me you're doing something. So we actually have that for certain clients, if it makes sense. And honestly, it actually is something that, like, thank you for having this in place during March of 2020 or whatever, right? That I can see, like, this happened and you did something, and now I can leave the rest alone. And the hard part is, like, we have the cognitive dissonance thing, that you can't have these two competing ideas in your head at once, right? And so it's hard for some advisors to have that competing idea.
Yeah, absolutely agreed. It's why this work is endlessly fascinating. Like, what's the spreadsheet optimal and what's the behavioral optimal are seldom the same thing. One idea in the book that I had not heard before was this idea of two types of bear markets. Can you talk about the two types of bear markets?
Yes. And I think it's really important to talk about it now, because we haven't had one of the types in a long time. And so the two types are like the recessionary bear markets, like really nasty. That's the Great Depression I was talking about. That's the Great Financial Crisis. That's like an economic contraction. The unemployment rate goes up. The economy slows. People lose their jobs. The bear markets tend to be bigger, badder, and longer. But then there's these other ones that occur outside of a recession for other reasons, right? The 1987 crash. In 2022, we just had one. Inflation rose and rates rose, so we had one. We didn't get a recession, but it was a bear market. And those ones, the magnitude isn't as big for the drawdown. It doesn't last quite as long, right? It's not quite as nasty. And I think it's a good reminder to people that, like, yes, they can happen outside of recessions. That's good to prepare for. But I'm really curious to think what happens when we actually do have another recession, even if it's like a mild one. How are people going to react? Because you probably saw the consumer sentiment numbers go back to like 1950, and they're as low as they've ever been right now.
Yeah.
And I just wonder, and that's with the unemployment rate is still 4.3% or something, right? Stock market's at all-time highs, housing prices at all-time highs, like wealth is all-time highs. There are obviously reasons this is happening. But if sentiment is low now, what happens when we have an actual recession and we see the unemployment rate tick up to like 7% or something, right? And we have a bear market that lasts longer than a couple months or something. Then how do people feel? And I just wonder if, like, it's been so long. One of the reasons that we had such a big freak out about inflation this decade is not just because higher prices sting. It's because we hadn't had inflation that high in 40 years. I had no experience with it personally. I probably underestimated how much people would overreact to it. Like the reaction by people actually surprised me a little bit. Like the reaction was so visceral and strong And you're like, oh my gosh, people do hate this. And part of it is because we weren't used to this happening. In the past, people were used to these huge inflationary booms, deflationary busts, but we had kind of ironed it out of our system a little bit. And then it comes back and you go, oh my gosh, this is terrible. And I wonder if that's how a recession is going to be too, where people are so angry that it finally happened again. Like, hey, we're not supposed to have this. What is this? And that's what I want to prepare people for. Like, it's probably going to be worse.
Yeah, we certainly have been lulled into security. Well, and I think this is what breaks people's brains too, that your gas can be so expensive. Like conditions on the ground can seem so bad. It's $100 plus for a tank of gas. Your strawberries cost an arm and a leg, on and on. Housing is unaffordable. And yet the market keeps rocking. And I think that is so hard for people to wrap their brains around. And that's why I think books like yours are important, because for the average person, their impulse is, my financial life sucks right now. Like, everything is expensive. It's kind of brutal. It's kind of miserable. Now seems like a good time for me to pull back, because surely the market can't be good when every time I interface with the economy, it's bad. And yet, here we are. And that's the difference. That's the difference between, I think, everyday boots on the ground sort of experience of the economy versus the markets. And the average person doesn't grok that disconnect, I don't think.
Yeah, I almost like this is the miserless company thing. Like in 2008, everyone was in the same boat, right? Rich people lost a ton of money, and everyone was kind of it. So you're right, that maybe that's why sentiment isn't low, because back then it was like, okay, at least everyone's on the same footing here, right? Yeah. Everyone's struggling, but now there's certain people struggling, but other people are doing fantastic. And you're right. You kind of go, wait, this can't be right. It's hard for me. And yes, if I'm not taking part in the stock market or the housing market, this stinks. I don't want this. This is not the environment that I want. So yeah, you're right. That maybe the counterintuitive recession would be like, some people are like, finally, those other people are feeling some pain too, like I've been feeling.
Yeah. Okay. At the risk of hyperbole here, one of the most brilliant things I've seen on Twitter in a long time was your tweet recently about winning points versus winning matches in tennis, and how that's an analog for the stock market. Can you break that down? I thought that was so good, and that's just something that's really going to stick with me.
Yes, the light went off of me. So Roger Federer gave the commencement address to Dartmouth a couple of years ago, and he talked about, hey, he's one of the most decorated men's tennis players of all time. He won like 1,500. He played like 1,500 matches, and he said he calculated afterwards he won 80% of his matches, which is an insane win rate, right? But he said then he calculated the points he won in those matches, and it was 54%. It's like, wow, it's like that small little edge compounding into win after win after win, and Grand Slam title after Grand Slam title, all these things. And I thought about it. I'm like, oh my gosh, my mind immediately went to the stock market. I'm like, that is the stock market. On a daily basis, depending on your time horizon, it's like 53, 54% of all trading days are positive, which is kind of crazy to think about. And the average daily gain in the stock market is 3 basis points, going back 100 years. Just 3. It's this tiny little thing, and it compounds into like 1,000,000% return over that time on a price basis. But yes, over the short term, that's the same thing as the stock market. And then over a yearly period, it's like the numbers are almost identical to like, going back to 1950, it's like 80% of all 1-year periods are positive. And yes, the light bulb immediately went off for me. And he had these great quotes about like not getting down on the losses and overthinking them and like wallowing on them, like those individual points, and thinking more about the matches than the points. And it was just a perfect stock market analogy.
Yeah, this is another thing that blows my mind. Like, and if you think about how, prospect theory and how we have asymmetries with respect to risk and reward, if the market's up, whatever, 55, 60% of days, and it's down 40, 45% of days, we know that we're 2.5 times as upset about a loss as we are happy about a gain. What's 40 times 2.5? Like if you're looking at your account every single day, it feels like you're constantly down. And this is where I think one of the best things you can do is just sort of set it and forget it. You can not look at it. You can only look at it quarterly or yearly, because yes, if you are looking at your account every day, the ups and downs become brutal. but you're still winning 80% of those matches. I thought that was so brilliant and something I'm really gonna hang on to.
I have a personal rule that I only look at my account balances during bull markets. I never look when the markets are down. I don't. Yeah. I kind of, in the back of my head, I obviously know what they are because I follow the markets, but I never want to look and see what it's like when things are really bad, just because I know that like it'll sting. You're right. It stings way worse to see that down number versus the up number.
Well, and even though, folks like you and I are following the markets every day, knowing the market's down 10% sort of big picture is very different than 10% of the dollars in my bank account down to the decimal point, right? I mean, it just feels so different. So I think that's a great rule. The last part of the book that I'll talk about, it is a great read. I hope everyone will go check it out. I love the epilogue, the 20 things I believe about investing. I'm a sucker for a listicle. If you could just etch, if you could tattoo this on the arm of every investor, what's the one of those 20 things that you think would do the most good for people to understand?
Oh, good. So I think one of my a good strategy you can stick with is way better than a great strategy you can't stick with. Mm-hmm. I've come to believe more and more. When I first started writing about markets, I naively assumed like there is a right and a wrong way to invest. And if people can just figure out the right way to invest and optimize, like they should be fine. And dealing with people has led me to believe that there is no like one perfect way for everyone to invest. There's a lot of good ways people can be successful investing. I don't believe anymore that this is the one way you have to do it, because I've interacted with so many people who have these disparate investment strategies that they've done and they come out successful, right? Yeah. I do believe most bad investors have a lot in common. Like the wrong way to do it is pretty similar, but there's many ways. And I think that, to your point, like trying to over optimize that this idea that perfect is the enemy of good, I think way too many people, and I think AI is probably going to make that worse in the future, where people are going to try to tinker too much and like make everything too perfect, right? And think about it down, like if you're getting down to the point where splitting hairs over, gosh, should I have 5% of my portfolio in this or 5% of my portfolio in this? Like you're probably already, it's horseshoes and hand grenades, close enough.
Yeah.
And I think that's the thing most people like. You just have to get something that you're comfortable with. And as long as it has a high probability of success, like then just stick with it and don't worry about whatever else is doing.
Yeah. Well, the book is Risk and Reward. I believe it was Christine Benz, our mutual friend of the show, that said on the blurb on the book that you're one of the great investment writers and thinkers of our generation. I certainly think that's the case. This is the kind of book that I think you could give to a new graduate or someone who's getting started in markets for the first time, and they could learn a lot of the most important rules all at one place and all at one time. Ben, if people want to learn more about you, your podcast, the book, where can folks learn about you?
Yeah, the book's available. wealthofcommonsense.com is my newsletter. You can sign up for it there, and I write about markets all the time. And yeah, book's out. I actually did the audiobook myself too, so you can hear my voice if you want to listen to it.
Yeah, dude, you're braver than me. I've never done the audiobook. I just picked some British guy to do it.
That's what they said. They said, do you want a British guy with an accent to do it? And I said, sure. And I said, wait a minute, I have a podcast. I'm going to try this. And honestly, it was very hard to do. So
yeah, it's felt exhausting to me. So you're a better man than me. But hey, man, thanks for all that you do to educate investors, and thanks for joining us today.
Appreciate it.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.